The realtor actually did sell their property within a day, but at that time, the other offer had basically waived their conditions.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren.
Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson. I'm joined, as always, by David Warren. We're both level 2 mortgage agents. Dave is also the owner at Referral Mortgages. We want to give a quick shout out to our sponsors, Guertin, Poirier, Avocates lawyers, big insurance in Westboro, CENTUM, and easy neon signs. Use the promo code TOREP and you can get 20% off each and every order. David, happy belated Thanksgiving. Go Jays, go. How you doing?
Not good.
Bit of a different tone, from last week's.
Not good. My head is in the sand.
Yeah.
The doldrum Tuesdays right now. Yesterday was, it was a tough one. It was a tough one. We'll be back. We'll be back.
How was your weekend though? You did you get any turkey in? Did you get some family time in? What's cracking? What's happening?
Zero turkey.
For David.
Zero turkey. Got a little bit of ham. Got to the Jays game though on Sunday with fantastic seats. So no complaints. No, it was, Little Jays losing. It was a good weekend all around, but it's a sore spot. It's a sore spot this morning.
Yeah. Well, on our end, we had a family dinner Saturday. It was nice. I got the leg of the turkey. That's my go-to. I like the leg. Other than that, good time. Boys are back. CP won their first game of the year, so we needed that. I need to get the monkey off our backs. Boys are buzzing. We're buzzing. Market's buzzing. We talked about this briefly, but last week after returning from my trip, there was a noticeable pickup in conversations and in activity, and it seems like last week was kind of I don't want to say a turning point because who knows what the future brings. It seemed like there was a lot more activity, and that's, I guess, to be expected as we talked about September. People are getting back into it, shaking the dust off from the summer, and thinking about long-term plans as far as going into the winter and so on. So a lot of people out shopping. I actually saw one person who had an offer. They put in an offer. Another offer came in, obviously. Price point was just over $1 million, and it was weird. I've seen a lot of people have put in offers, but they always have the right of first refusal. So we're seeing them basically have the condition of them selling their own home first. And twice this has happened in the last month where a secondary offer has come in while they were in that waiting period to sell theirs. And then they had to get a lot more aggressive. Like, well, can we waive our conditions? Can we do this? I said, it's kind of that same conversation. Like, you need to protect yourself. You need to go into this. Obviously, like, there's no guarantees you're going to sell your place. Homes are sitting at times. So seeing that a lot more where people are needing to sell their place or putting in that condition, which, that is to me a sign of a buyer's market because that hasn't happened for a little while. You see that every now and then, but now it seems like it's a pretty standard condition, at least in the last few APSs I've seen, where people have that condition to sell their own place first. And the funny thing is about this one is that the realtor actually did sell their property within a day, but at that time, the other offer had basically waived their conditions. So just a very weird set of circumstances, but overall, it seems like the fall market has arrived, David. Leaves are falling, or prices,
Yeah. No, I will say my conversations are centered around a lot of renewals. Personally, I haven't been dealing with as many purchases. I do have clients, kind of to what you're saying, where they did not have a condition of selling their home that they're closing in November and still haven't sold. So, kind of one of those, we plan for the worst ahead of time of how do we navigate this if it's not sold, kind of going into that B space, converting it to a rental, refinancing to pull out equity, whatever it may be. But, those are conversations we have at the outset. But I certainly do have some November closings for purchases where they still haven't sold those properties. But yeah, this last few weeks, it's just been, on my end, just more the renewals. We talked about ad nauseum about it, but just so many people up for renewal. Those conversations are kind of that planning 4 months out, and then, kind of that 45 days out.
So what's the conversation on those? Like, is it people like, not from a rate perspective, but also are people looking to lower the payments? Are they looking to just kind of like kind of reset and keep everything the same with the same lender? Like, what are you seeing as far as those conversations with regards to the renewals?
Yeah, it's pretty mixed bag. A lot of people wanting just to renew dollar for dollar. They don't want to increase payments. They know that they're going from, a 1.69 fix to, a high threes kind of thing. And they know that the payment is going to increase. So they're not wanting to do anything there. And then others where they're like, you know what, I'm want to do some updates. So they're increasing, but, or consolidating some debt. And others where it's, Friday conversation where it's just, this is what I'm paying now. They're paying like $760 biweekly and they want to just maintain on that. And so we're like looking at just adjusting the amortization to match up so that they don't have any real change in that payment. So it is a time in which everyone's unique in their situation and financial situation. And, and really over the 5 years from when I helped them originally, they're in a different financial position in a lot of cases.
Yeah.
We deal with a large predominant portion of our client base as brokers is actually first-time home buyers. And so we kind of work with them through their life cycle of their home ownership career. Their first home, they're in their first job, or they're just out of university. They're in their 20s. They may be buying with a girlfriend or a boyfriend and they, there's no family there. And then, you kind of talk to them over the years and now we're 5 years out and they have 1 or 2 kids. They're now married or, they've changed careers and they're in, much different financial position in a lot of cases. So really it is every conversation that is different, but we kind of, as brokers, we do have a lot of tools in our tool belt to be able to, adjust amortizations where, the banks don't necessarily have that by, switching lenders. Or right now this morning, working at removing a son off the parent's mortgage, putting a different son on, like at the time of renewal, or taking the parent off at renewal because the son now qualifies. These are all kind of times in which like you can do things with the mortgage. So it's a lot of different conversations, but yeah, there's been many.
Yeah, I agree. That's a good point with regards to the employment and also the growing families, because it is like sometimes you talk to people, like you said, basically just a young couple buying a 3-bedroom. And now they're like, oh, we've got a second baby on the way and we need more space, and then they're kind of considering like over the next 5 years, what are options as far as portability and like what do penalties look like and so on. So the conversations do shift, but it is always nice when you have that conversation. And for us to, like 5 years goes by so fast, 3 years, I talk to clients and it literally feels like you talked to them 6 months ago and they feel the same. It's like, oh, didn't we just do this? It's like, yeah, but here we are, we're back. So it's nice to kind of see how much can change over that 5-year time frame, reflecting on that. But what are we seeing? I know the job numbers came out, September job numbers, which will impact obviously a potential rate cut in October. Basically, I can summarize this quickly for us here. So Canada added 60,400 jobs in September, fully offsetting August's losses and showing unexpected labor market strength. Economists are split. Some say this reduces the need for another rate cut, while others point to weak quarterly averages and persistent slack as reasons for easing. Bond yields rose briefly, led by gains in manufacturing, healthcare, and agriculture, while youth unemployment climbed to 14.7. That's probably the most staggering. The report places new pressure on the Bank of Canada ahead of its October rate decision, making inflation data even more critical.
Yeah, certainly the job numbers were to that point like surprisingly strong. There was obviously losses in some areas, but overall it certainly kind of makes things a little confusing and contributes to kind of that confusion of what's going to happen October 29th with the next Bank of Canada announcement. Really the decline of 47,000 jobs, like you said, completely offset by it. But what it did do is, with those numbers coming out, it shifted the Bank of Canada, like the probability of a decrease. Really in the market right now, based on that job strength numbers, we're seeing economists kind of predicting within the market a 25 basis point cut is at a 56% chance and no change at 44% chance. And then in the US, their announcement is actually the exact same day, October 29th, and they're a 96% odds of a 25 basis point cut and a 4% of no change. So, obviously Canada basically being almost split down the middle, US most certainly guaranteed to have a reduction.
Yeah, I just had the bond chart up there because they were talking about a slight uptick. So The bond market it's kind of been stagnating a bit, but on the lower end. Now fixed rates haven't really moved much, as we said, like in July, July 15th, bonds are sitting at 3.13. We're down now at 2.66 as of this morning. So it's come down a fair amount, at least from a bond rate standpoint. Fixed rates have reflected slightly, but not as much of a move as we would have predicted. So where do you see, do you think, I'm going to pull this up just one more second here. I think we had it, but just for anyone who was listening, if you wanted to come check this out. So this kind of shows, I put on a 6-month trend here. So you can see it is pretty consistently big drop in end of September. And then it's just been kind of holding in that kind of 2.6 to 2.7 range. So when, if ever, do you think we'll see banks drop that fixed rate? Because that's a question that we're kind of fielding daily.
Yeah, I mean, to your point, what you just mentioned, it's down basically 50 basis points from August. We haven't seen fixed rates come down by that equaling amount. I think what the challenge for the banks are right now is that there's a lot of instability within the market and a lot of instability with what is being said south of the border. Case in point, Friday, the market's lost $1.5 trillion of a market cap because of comments that there will be counter tariffs. Like everything went off the cliff on Friday with the blockbuster jobs report, but that didn't stop the Canadian yields from falling. The driver was Trump's comments about threatening to impose on China tariffs on rare earth minerals and new fees on U.S. ships and other actions, and so that really spooked the market and really kind of sent the indexes dropping 1.5 to 3.5%. So we really have been seeing that. But I think what makes it challenging for a lot of the banks is that because there's a truth social or an ex post by the president, it fluctuates the market so much and it's so volatile that I think they're holding off on making really rate reductions aggressively because they could go the other way and they need to they're hedging themselves right now because of that. And so I think they need to kind of see it stagnating and kind of, like you showed on that chart of it, for the last month has been more so kind of just riding that one linear line of kind of waiting for that to kind of stabilize over long term before dropping them. But I think we'll start to see some movement over the next 4 weeks as the Bank of Canada makes a decision, as we kind of see, in the Middle East, we've kind of had some good news this past weekend there from a political standpoint, that hopefully that kind of calms things on that front a little bit. But yeah, I mean, really kind of it goes back to us needing to kind of sort out this tariff and CUSMA issue to kind of stabilize the markets and provide the banks the reassurance what they need to really kind of start hammering those rates lower.
Yeah, pretty wild too. That post was on Friday, as you mentioned, and then Monday was obviously a holiday here in Canada. But on Sunday night, President Trump made another Truth Social post saying, don't worry about all that China stuff. Things will be okay. And then the market yesterday rebounded a full 2%, 3%. Some stocks up, 20% back yesterday just from his tweet. Or from his post. So it's pretty wild. I had this conversation with a friend yesterday that the amount of, in 2025, the amount of retail investors that are adding money to the market is unprecedented. And the combination of that and all of the large institutions' algorithms is making these outrageous swings in the market because they're, those algorithms are triggered by certain price points and volume and so on. And with all these retail investors basically getting into the market, it throws off all those algorithms. So we're seeing 25% return days on some stocks and the same drops on the other side just because of all these triggers. The other thing, banks in the US today had their earnings and all of them beat their earnings. All of them had really good returns. So it'll be interesting to see how that impacts the market and also how that impacts in the US, what their decisions are as far as rate cuts and so on. But it's interesting they're both on the same day. I don't think that happens as frequently, but the last two now have been kind of lined up, you could say. It's interesting how theirs is such a higher guarantee when really we're, kind of the, the little brother in the sense of from an economy standpoint.
Yeah, they haven't, but we had a number of consecutive drops. We've come down quite a bit from our high, whereas they've only had the one. So I think that's obviously contributing to it, and obviously the pressure from Trump wanting the feds to drop their rates. But yeah, we'll kind of again, we'll kind of see what happens. A lot can still change between now and the 29th or the next 15 days. But yeah, I mean, really from a Canadian data standpoint, there's not really much this week. The US does have some retail sales numbers, PPI and non-farm payroll numbers coming out. So that will contribute to what's kind of happening south of the border, which, like we always talk about, does impact here.
And even with the government shutdown, they have those numbers, right? Because I know there was talk for a while that with the government being shut down in the US, that some of those numbers wouldn't be available. That was my understanding, but this was a week ago. Like when it first came out, they're saying, oh, we're going to be missing all these numbers. And they're saying no data is worse than bad data because it's the unknown definitely impacts the markets and so on. So I'm not sure what's happening with that. I actually don't know. I'm not saying you're wrong. I just don't actually know how that's going to work.
No, I mean, I agree. And to your, like, that they're supposed to be announced this week. And to your point,
yeah.
We'll see. But yeah, I mean, that obviously has drastic ramifications of the shutdown in the US of the government.
Hopefully be back soon.
Well, I mean, it also
seems to be working
when they have no federal employees being paid and a lot of people living paycheck to paycheck. I'm curious to see, depending on how long it drags out, how it's going to impact credit ratings in the US as well. There's going to be that ripple effect that comes with it.
Are you trying to grow your mortgage business? CENTUM has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with CENTUM. Learn more at CENTUM.ca. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Guertin, Poirier, Avocates lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at guertinpoirierlaw.ca. Let's get to the heart of your deal. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. This episode is brought to you by Easy Neon Signs. Visit easyneonsigns.ca and use the promo code TOREP, TOREP, to get 20% off each and every order. easyneonsigns.ca, Canada's finest custom neon sign maker.
North of the border, here in Canada, though.
Well, yeah, Canada, yeah.
Last week, we touched on those OSFI news that came out and what was said and kind of this interpretation of what was going on. And it seems that it's all for naught, that even our concern last week, all of the news out there, all of the other posts and other YouTube video, whatever kind of the rabbit hole of information that was coming out. And so I want to kind of just read this update. So on September 25th, OSFI's Mark Joshua warned banks that income used to qualify one mortgage cannot be used a second time for another mortgage. That led to widespread confusion in the industry. That statement was merely meant to explain OSFI's new criterion to identify income-producing residential real estate exposure for capital purposes. The original proposed criterion was essentially that all rental properties be labeled as IPRRE, is the acronym, or abbreviation rather. An OSFI spokesperson told MLN, which is a mortgage news organization. In the end, OSFI decided to remove its proposed new criterion. We have maintained the prior criteria that the loan be considered IPRRE if more than 50% of the borrower's income used in the institution's assessment of the borrower's ability to service a loan is from cash flows generated by the residential property. More importantly, the regulator has since clarified that there is nothing new in the capital requirement that would affect underwriting standards, and OSFI's risk weights remain the same. Hence, the brief industry panic that ensued was all for naught. The takeaway for OSFI: mortgage professionals hear your words, not always the meaning. Thus, explain mortgage-related guidance like instructions for diffusing a bomb. No room for creative interpretation. So all that to say is nothing is changing. This was really kind of similar to what you mentioned about a True Social post from Trump on Friday about China market tanking. and then Sunday saying everything's all good and the market bumping back up.
Yeah, don't worry about that stuff with China.
So
It'll be
kind
okay.
of so similar to this is an OSFI representative made an off the cuff comment, which then sent, I was getting emails from clients, kind of seeing this, reading this, wondering what the heck's going on. We were getting messages like crazy from listeners, obviously us, even leading up to last week's episode, kind of trying to dive into what the heck this means and really trying to interpret everything. And then really them realizing that, hey, this off the cuff comment was leading to panic and we need to actually clarify things. So, really, in all that said, there was smoke, there is no fire. And we'll be able to, for now at least, it seems like things will maintain status quo as far as how mortgages on rental properties are qualified. I'm curious though, if whether the off the cuff comment is something that they have been toying with in the background. Yeah. As far as regulatory changes or underwriting changes. And it was a slip of the tongue without kind of the forethought of like rolling out this new criteria and where that kind of stemmed from. So I'm curious if like down the road, there is any changes to come, that this was kind of what he was referring to, but I guess time will tell. There's always changes in our industry that make it harder to qualify. So
yeah.
Keep rolling
so to make it crystal clear, it basically states that the applicant's income cannot be coming from more than 50% just from that rental property. So as long as they have like a base income and they have
but really that if it is
the same as it is now.
But yeah, but that if it is, they just have to mark it on their on the bank's balance sheet as being like identified as income producing residential real estate exposure.
Right.
Like for capital purposes. So they just basically have to allocate that, yes, this is a higher risk mortgage, and they maybe have to allocate a little bit more extra capital, but they're already having to do that.
Right.
Hence why rates on rental properties are higher, because they already have to allocate, different funds for those. So no need to panic, people. No need to panic, ourselves included.
Yes. So another something I was reading this morning with regards to OSFI. So I'll just summarize it quickly here, but the title is basically that OSFI's Routledge mulls changes to boost competition in the banking space. So it says Peter Routledge, who's the head of Canada's banking regulator OSFI, is signaling potential shifts in regulatory posture aimed at increasing competition in Canada's banking sector. Speaking publicly, he expressed the view that the regulatory system has a natural bias toward conservatism, prioritizing the avoidance of institutional failure, which may inhibit innovation or the emergence of challenger banks. He suggested that easing or recalibrating capital rules could lower barriers for smaller institutions and promote lending to underbanked or underserved sectors, thereby stimulating productivity and competition. At the same time, he acknowledged that OSFI is closely watching emerging risks. The condo markets in Toronto and Vancouver have been under pressure and could spill over into the broader financial system, while increasing delinquencies in variable rate mortgages among self-employed borrowers and among investors are signals of vulnerability. Routledge highlighted that elevated household debt and concentrated exposure in certain real estate submarkets amplify the sensitivity to shock. However, he reassured that Canada's banking system remains well capitalized and structurally resilient, suggesting regulators believe the system can absorb stress even as they consider more leeway. He also echoed criticisms from Bank of Canada's Deputy Governor Carolyn Rogers, who has criticized the dominance of the large banks and referred to the oligopoly features of Canada's banking system. Overall, the article frames that this is a moment when regulatory philosophy may shift modestly towards accommodation, balancing between the desire to spark competition and the imperative to guide stability. So, in your opinion, Dave, do you think it's worth loosening the regulation to foster that competition, or does that risk kind of undermine the financial stability? Because we see, I know in other countries, we see a lot of these like new kind of financial tech tools that are actually offering bank. I mean, even in Canada, we're seeing like the Wealth Simples of the world offer now banking and trading for retailers and so on. As I mentioned, there's a huge upswing of retail investors. Also, the banks in the US today, and this is something that's been talked about for a while, are talking about tokenizing the actual banking system, where that's kind of like the online, digital financial system, which would allow more people to enter the market, more people to be able to buy stocks, buy real estate that way. Open doors, something that's been turning a lot of heads in the US, where people can basically use online tools to buy and sell real estate. So there's a lot of this stuff happening. So do you think at this point, is this the point where they should be loosening things up to allow more competition? Or do you think we should be keeping everything kind of status quo here in Canada?
I think more competition is good for Canadians. Like by having so few in any area, you look at telecom, you look at banking, these major industries, we have so little competition that all it does is cost Canadians more. When you've got only 3 telecom companies of like Rogers, TELUS, and Bell, like, they can price whatever they want, and why we have some of the most expensive the most expensive plans and mobile and internet pricing in the world. Same as banking, like, having 6 banks and really 2 banks that control everything, or 3 rather, like RBC, TD, Scotia, basically controlling everything. There's no need for them to innovate. They don't need to bring in new tech. They don't need to do anything. They can price fees. They can fee us out the wazoo as much as they want because there's nothing that we can do. There's not enough competition. I think this is also potentially setting things up for, in negotiations with the US. I know it's been a big push by the US to have US banks to be able to operate in Canada. And I think this could be a precursor of a comment that this is something on the table for negotiations with the US when it comes to like tariffs or CUSMA, is allowing US banks in. Canadian banks operate in abroad. TD Bank has is TD US. Scotia is in a major Caribbean bank. Like, we're all over the Caribbean and
South America now as well.
Yeah, and South. Like, other countries allow us in. So, anyone listening to this saying like, oh no, we can't have American banks in here. Like, we operate already abroad and we're allowed in other countries. Like, why wouldn't we allow other institutions, as long as they're following the regulations and they're following, the stops that we have in place? Really, we have the barriers that we have for lending and things like that in the mortgage industry and all that has been thus far like kind of shielded us from what happened in the US. But if they come in and they maintain that same path and play by the same rules, like I don't see how they can be an issue for Canadians and not be of benefit.
Yeah, I completely agree. Couldn't have said it better, David. Couldn't have said it better. How about some boosts? I got a couple turkey boosts, a couple Thanksgiving boosts.
Oh, I like it. Let's
Just
do it.
It's a little topical. It's a couple days late, but it's coming. It's not. Hey, it hasn't been Thanksgiving in the U.S. yet, so we'll just, since we're talking too much about the U.S. I got 4 today for anyone who's willing to listen. So here we go. Number 1, why did the turkey carry a microphone? He was ready to roast. Ready to roast. Number 2, nice hybrid here. What do you get if you cross a turkey with a ghost? Poultrygeist. Poultrygeist.
Wow. Oh, wow. Wow.
Number 3, why did the turkey join the band? He had the drumsticks. Drumsticks. Speaking of drumsticks. Little full circle there from the beginning. And last but not least, what's a turkey's favorite dessert? The old peach gobbler. The old peach gobbler.
Okay. Not bad.
It'll do.
It'll do. It'll do, donkey. It'll do.
Thank you, everyone, for tuning in. If you're still here, thanks for listening. Make sure to follow us on our socials. Shout out again to our sponsors, Guertin, Poirier, Avocates Lawyers, Big Insurance in Westboro, CENTUM, and Easy Neon Signs. Use the promo code TOREP, 20% off each and every order. David, thanks for being here.
Thank you,
Go Jays,
Paul.
Go Jays, go. We'll see you soon. Deuces.
Deuces.